Welcome to the first of a series of updates from myself, Matt Bowen, and Oliver Knight from the Residential Research Team.
Thanks, Matt. So in the next 10 minutes or so, we just want to give you a bit of an update as to our latest thoughts on coronavirus with regards to its impact on the housing market and also the economy. But perhaps before we get into the slides, the first thing to note is that we are still very much in the early days when it comes to fully understanding the long-term impact of what's happening. And as such, the numbers we're talking through today, which are correct as at the 3rd of April, are liable to change. We can and we are, however, trying to glean as much information as possible from this data. And to this end, hopefully you will all have been receiving the daily research note from Liam Bailey, which really aims to just contextualise the current situation. So let's start by looking at the economy. We have 3 charts to talk through here, all related in their own way to the property market. Just as background, we've adopted the latest forecasts here from Oxford Economics, whose outlook is based on the assumption that the current very restrictive lockdown will remain in place through April and May, with a gradual lifting through June. But if we start with GDP, what we can see here is that their central scenario is that we're about to enter a short, sharp recessionary period, followed by a rebound in early 2021, giving us this V-shaped recovery. The peak effect on the economy is likely to be in the second quarter of the year, with a gradual recovery following that. Now, that is relatively good news in so much as it can be considered such, and very different from this long and drawn-out L-shaped recovery that we saw in the wake of 2008. Now, one of the reasons for this prognosis is the immediate and extensive policy response that we've seen from the government, and further measures to that end cannot be ruled out.
Now, unemployment is another key indicator to watch. At the last count, unemployment across the UK stood at 3.9%, a near record low. There is little doubt that this figure will rise in the wake of the COVID-19 pandemic. The big question is by how much. The current projections from Oxford Economics suggest unemployment will peak at 4.17% later this year, before returning to current low levels by Q3 2021. However, it's worth noting that more recent data released on April 1st, looking at new claims for universal credit, suggests that the unemployment rate jumped to around 5.5% in April. But just for a bit of context, post 2008, unemployment peaked in 2011 at 8.5%, you can see from the chart. The final economic element that we want to look at is interest rates. The Bank of England acted swiftly and made 2 emergency interest rate cuts in March, first to 0.25% and later to a historic low of 0.1%. Low borrowing costs and the availability of relatively cheap credit have been 2 big factors underpinning property markets over the last decade. And these moves suggest that this lower for longer environment will remain in place. In fact, Oxford Economics expects rates will stay below 1% until Q1 2023 and only rise to 1.5% in Q4 2024. There are, of course, other issues around lending, with some banks cutting back on new mortgage products or demanding higher deposits. However, we understand from our conversations with Knight Frank Finance that lenders do continue to show appetite to lend.
Yes, and on that point, it is worth noting that figures from the Bank of England show that mortgage lending actually hit a 6-year high in February this year, the month before the coronavirus outbreak in the UK, which goes some way towards highlighting the relative strength of the property market at the start of the year, and may well suggest that once those restrictions are lifted, we could see a relatively swift bounce back. And it is worth looking back and taking stock of the market at the turn of the year, when there were real signs of resurgence in development markets and resales markets across the UK, buoyed by that clarity that we saw surrounding Brexit and also that Conservative election win in December. Now, we've talked about it before, but it is really worth reiterating that on the back of both of those things, we saw big upticks in new buyer registrations and viewings, and also in offers and sales. However, it has become very clear very quickly that the coronavirus presents markets with new challenges. And as expected, there has been a sharp drop in demand over the past few weeks. As you will know, restricted movement brings with it its own unique challenges with regards to viewings, inspections, and also surveys.
It's worth noting that activity is by no means ground to a total standstill, though.
Very true, and there's plenty of anecdotal evidence that deals are progressing, particularly overseas. And let's not also forget that those buying in US dollars are also benefiting from an effective discount of nearly 40% on central London property since the middle of 2014. And in normal conditions, that's the sort of discount which would make most buyers double take. But even so, the new homes market is subdued and will likely remain so until movement restrictions are either lifted or loosened.
Yes, it's interesting to look at what happened in Asia on that last point about restrictions being lifted or loosened. Our teams in Singapore tell us that whilst restrictions are still in place, they are still able to meet clients for in-person viewings and lawyers for transaction-related matters. However, viewings are staggered and spaced out within the day. They're also leaning more heavily on technology via interactive links to showcase properties and online webinars. The other point to make here with regards to the market is that taking into account where we were before the crisis hit, we do expect that current suppressed levels of activity will lead to a build-up, latent or pent-up demand. Combine that with the prospect of tax changes in the form of higher stamp duty for international buyers next year, and we may see activity return pretty quickly.
It's also worth touching at this point on the impact the current situation is having on the development or house building market, with those restrictions presenting real obstacles to housing delivery. A number of house builders you will have seen have already announced that they are suspending construction on sites, and inevitably longer term, this will mean a drop in new home completions this year and also probably next. But as discussed, they are still open for business, and conversations with agents do reveal evidence of deals being agreed at all levels of the market, from help to buy transactions all the way through to prime new home sales. Now, more comprehensive new homes market data for the first 3 months of 2020 in London is due later this month, and we will update our views accordingly. But in the medium term, what we may start to see is a shift to recently completed product as buyers and investors look for tangible assets. Now, a pause in new homes delivery also comes at a time when completion volumes in England have been steadily ticking upwards, as we can see from this chart here. Just weeks after the government reiterated its ambition to build 300,000 new homes a year by the mid-2020s. Now, the latest figures show that just over 240,000 homes were added to housing stock in England last year, up about 9% on the previous year, but some way below that 300,000 target figure. And it's clear that meeting that stated goal requires decisions that go well beyond the next few weeks or even months. Now, the current view remains that this disruption will be relatively short-lived, and indeed developers are still pursuing longer-term projects. Now, we may start to see a further shift towards the build-to-rent sector going forward, should demand be slow to pick up once restrictions are lifted. And I know, Matt, you have some thoughts on that.
Yes, whilst PRS build-to-rent and other purpose-built accommodation projects aren't immune from the short-term implications of coronavirus, the outlook for investors looking at residential remains positive. Projects that are under construction are also being paused, and some owners and operators of operational assets could face short-term risks to income. However, the outlook for investors looking at residential remains positive. In fact, what is becoming increasingly clear from a number of our clients in this space is that the impacts of coronavirus on the performance of other asset classes may mean they actually accelerate their existing plans to expand investment into residential. And here's why. Firstly, and chief among the reasons, is the fact that investors see the strong ties that rental markets have to demographic trends rather than economic cycles. Demographic trends are far easier to predict in the economy, and right now that's a real positive. It means that regardless of any short-term economic shocks, the fundamentals which underpin the demand for rental products will remain favourable. And we've seen this previously in the global financial crisis.
Yeah, so we can see it quite clearly here in the chart on the left of this slide, which shows long-term rental performance against UK recessions since 1977. If we take a look at the most recent recession, for example, the global financial crisis in 2008, rents actually increased by around 3% during that time. Now, if you compare that to what happened to capital values, they fell around 15% on average during that period.
Yeah, and we can also take some guidance from what happened previously in the States when the multifamily market is more mature and more established. We spoke to Mike Wolfson, a capital markets researcher from Newmark Knight Frank in New York, and he was quick to point three things out. Firstly, the degree to which the global financial crisis acted as a catalyst for people to change their perspective on home ownership. When the dust settled after the crisis, there were more people wanting rental product across all markets than ever before. And secondly, the size of the bounce back in values and returns within multifamily post-recession were huge and significantly outstripped all other asset types. We can see this demonstrated in the chart here to the right. And thirdly, there was a real recognition among investors of the non-cyclical nature of housing. And that is that this is continuing to create a bull market in the US for multifamily.
Definitely. I mean, it's definitely a positive story, especially that potential bounce back when life returns to normal. And it's something that really underpins our view that the residential investment sector is well placed despite the current uncertainty.
Yes, it's worth reiterating the fact that around 20% of households currently rent privately, up from 10% in 2001. In addition, there's been a real generational shift in the PRS. More households are now living in rented accommodation for longer. And while housing affordability is definitely a factor, rented accommodation is also becoming an established flexible form of tenure, especially among young workers. The key factor in the coming months will be what happens to unemployment. For now, though, pledges of unprecedented levels of government support are keeping unemployment forecasts relatively low.
Thanks, Matt. Hopefully that's been a useful overview of where we see a fairly diverse range of markets at the moment. Do please get in touch with either Matt or myself if you had any questions.
Yes, and also if there's anything else you would like to see covered in future updates, then please let us know. Thanks again and stay well.